Good evening. I'm Jim Linzet, the director of the Robert S. Strauss Center for International Security and Law here at the University of Texas at Austin. I want to welcome you to our conference, Bridging the Gap, Universities Meeting Global Challenges. Our talk tonight is A Changing World, a View from the Private Sector. And it is my pleasure to welcome here to Austin and the campus of the University of Texas my fellow panelists. To my left, Paul Rogge, and to my right, Jim Doherty. I guess I will go in reverse alphabetical order and say Paul Rogge is portfolio manager and founder of Rogge Capital Management LP, which is a long and short equity investment partnership that invests primarily in non-U.S. equities. Before starting Rogge Capital Management, Mr. Rogge was a vice president and co-founder of AIM Capital Management's International Investment Management Unit. This unit managed approximately $8 billion across 9 primary funds. Paul left AIM in mid-1999 and started Rogge Capital Management in November of 2000. He is a native of Lincoln, Nebraska, actually a small town just outside of Lincoln, Nebraska, Tecumseh, as I understand it. He received his Bachelor's of Administration degree in 1988 and his Master of Business Administration in 1991. Both here from the University of Texas at Austin. So welcome, Paul.
Thank you.
Again, to my right is Jim Doherty. Jim is operating partner with Great Hill Partners, a private equity firm based in Boston. He has successfully turned around and built several companies. Among other things, he has headed Lotus's internet division, and he was CEO of Prodigy Software. Jim also serves as a Senior Fellow in Business and Foreign Policy at the Council on Foreign Relations in New York, where, among other things, he runs the Council's widely acclaimed Roundtable on American Competitiveness. Jim holds a Master's in International Economics from Columbia University. I believe it's the School of
International Public Affairs.
SIPA, which is an excellent school. And he has his BA in Public Administration from Framingham State College. Jim, welcome to Austin.
Thank you.
As I mentioned, the topic for today's discussion is A Changing World, the perspective from the private sector. And I would say as I look around, we certainly, I think, can agree it's a changing world out there. If I were to go back a year ago, at least based on the status of my retirement portfolio, things looked mighty good. I believe last spring the Dow Jones Industrials was a little bit over 13,000. Economy seemed to be going fairly well. I look at the New York Times and my BlackBerry just before we started here tonight. Slight digression, if you have a cell phone or BlackBerry, please turn it off because it interferes with the sound system here and we'll start hearing howling and squealing of technology. But when I checked the NewYorkTimes.com just before we came in here, the Dow, I guess, closed around 7,500 for the day, which is about, I guess, something like 41-42%, not count too carefully, from its high last spring. Certainly on Wall Street, a number of venerable firms are no longer in business. Lehman Brothers, Bear Stearns, Merrill Lynch is no longer a standalone outfit, having been bought by Bank of America. Moving outside of Wall Street, we look around, plenty of layoffs. We see GM and Chrysler are both clinging to their lives and have needed infusions of cash from the federal government to stay in business. So certainly things have changed quite rapidly for the United States. And I guess what I'd like to do is there's an opening question, and I'll direct it to Paul. Are things as bad as they seem?
Sounds like a cliche, but yes.
Okay.
It is.
Now to dinner.
Sorry?
We're done.
Thank you. No, to give you a little bit more of a background, I've been involved with international markets for 18 years. Prior to that, I was here at this great institution, the University of Texas, and had the great fortune to have Dr. Walt Rostow as a professor of mine. And one thing I think I got from that class was really, I think, a historical perspective on the boom and bust cycle. In a way, it's the same story played out over and over again, just to a slightly different tune, with a slightly different flavor. And once again, we have seen now in the last decade 2 great booms and 2 great busts. First with the technology bust, which then led to lower interest rates, which then led to a housing boom, and now this bust. The one thing, at least in our shop, I don't know about yours, is we're looking at this decline as radically different decline than past recessions. That this is really a liquidity implosion, not a short-term overcapacity problem in one specific industry. To put some numbers on that, if you look at U.S. debt to GDP ratios now are over 300%. You have to go back to the Depression to find those types of numbers. And I'm not one of those people that believe that we are destined to go through a horrible time like the 1930s at all. I think there's a lot of things that could be done on a public policy front, on a regulatory front, to avert this. But I would like to get across, at least how we feel, that it is a much different problem where you have overcapacity and you have such a dramatic drop now in world trade, where it is playing out in an eerie similarity to the 1930s. I would hope that with the new administration, we might be able to get bank lending and bank borrowing, looking at the same coin from different sides, going again. But like I said, from our standpoint, it's...
Let me ask you a quick question there, Paul, just so we get our terms clear. What do you mean when you say this time the problem is a liquidity implosion as opposed to overcapacity?
Right, where you have a fundamental overissuance of debt. It is not an overcapacity so much in one industry or an overspeculation, at least from my standpoint. Equity markets did not get dramatically overvalued on a PE basis or price-to-book basis. But in essence, you have, going back really to the fall of Bretton Woods in the early 70s, you've had this tool of monetary policy which has been pumped so much more with each downturn in the economy, with having a relatively smaller impact on GDP. For example, when Bretton Woods fell apart, for every dollar creation in debt in the U.S., you had a 60-cent impact on GDP. That ratio steadily fell from the early 70s now to 2008, where that dollar creation only caused 20 cents in increase in GDP. And that means that tool or that pump that we have been using for the last 38 years is now not nearly worth as much as what we thought. And that's why interest rates around the globe have gone to zero, and we have still seen relatively little impact on the economy. We need a different and new answer.
Is it different, Jim, or from your perspective, sort of just the repetition of the old business cycle?
Oh, it's very different, but I wanted to mention a quick story. I travel to 3 or 4 U.S. cities every week, and then I ask every single person in every single hotel, taxi driver, everybody asks the same question. Everybody tells me, roughly, business is down, 25 to 40% year over year. And I asked the gentleman who drove me from the airport today, and I asked him about his business. He said, no, things are much better here in Austin than other places in the United States. And I said, why is that? He said, we diversified after the dot-com explosion. I said, well, what did you diversify into? And he said, financial services and real estate. I said, okay, fine. Okay. I said, I'm not going to ask him any more questions. That is, no. So, from a personal perspective and from a business perspective, so we're a private equity firm. We give sort of companies that are around $75 to $100 million in size capital for them to expand, and we only invest in companies that are using information technologies to change the competitive dynamics within the marketplaces. So what that means is, so far, most of our 22 portfolio companies are actually not showing significant signs of the downturn. In fact, we have a payroll company that just processes payrolls that was in January. It was up 28% year over year. So one of the things we seem to be benefiting at least a little bit as more traditional competitors go by the wayside. People who are employing technology because it saves money and you get a faster ROI. We're hanging in there.
ROI, return on investment.
Return on investment, yes. But we also know that if things get bad enough, that's not going to last forever. And if things continue to plunge the way that we see them plunging, all of our companies are going to be adversely affected. We hope not as adversely as our competition. But what we see when we go around and meet our competitors, we meet new companies, we are seeing in companies that we don't invest in, tremendous fall off in just like a rock. Starting November 1st, December 1st, things just fell like a rock, and there seems to be they seem to still be accelerating at an accelerating rate. which is not what you want to hear right now. We don't see any slowdown in the decline of their new business, their bookings, or anything like that. Obviously, we're not investing in those companies. We're keeping an eye on them. One of the outcomes of this whole experience is that we closed our fourth fund in June at $1.2 billion, and so we are in good shape. And we have done a capital call. We called for our, money from our limited partners in the late fall, and everybody came through, which was a concern in a business like ours, where the pension funds that you invest their money oftentimes don't have money, and some of our competitors have been unable to deliver on commitments to companies because the pension funds from which they take the money are illiquid or in bad shape. So we are seeing this other group of companies and watching them, and our biggest issue right now as we see them fall is that when do we swoop in and make an investment, and how much further does it have to go? So we are seeing no signs of a bottoming out, unfortunately, as we sit here today.
So let me make sure I understand this. You work for a private equity group.
Correct.
You raise money, and then you use that money to decide what companies to invest in, either buying companies that are private or potentially buying public companies and taking them private?
No, we don't buy. We only provide growth equity to private companies. We don't buy public companies.
Only private companies. But so at the end of the day, you're looking out there among sort of a constellation of potential good investments, buying a good company. You're hoping you're going to get one that's in good shape, good growth business, and go forward. Now, Paul, you're in the hedge fund world.
All of our companies are public.
So explain to me what hedge funds do, since they've gone from being totally obscure to being on the front page of USA Today. And
for often bad reasons.
But whether for good or for bad, if you just sort of give us a little tutorial on what hedge funds do and how it's different from private.
Right, and frankly, I think it's nice to set up a panel to have somebody from private and public equity. But essentially what we do are companies that are already public, that meaning that they have stock that's traded in equity markets around the globe. We take positions in those stocks, either long or short. Short meaning that we borrow the stock, sell the stock without owning it. If the value of that stock then falls, we can buy the stock. So you usually hear the phrase, it's good to buy low, sell high. In my world, we can reverse that, sell high, and hopefully buy back lower, therefore make money on that transaction just in reverse. But we deal with more public information. My decision making oftentimes can be in the next 24 hours things might change because I can act on them almost instantaneously in the capital markets. It also involves the FX markets too in order to cover those transactions. This fellow has to deal with a much longer term investment than what I do and cannot change on a dime in the next 24 hours. And that, though, I think also brings into, as I've seen more capital markets develop, really since 1990 when I started in this business, the interaction between investment and foreign exchange has begun to accelerate and amplitude these swings and booms and busts in the emerging markets. Now, that's a long phrase, but that's one thing I'd like to get across today as far as a regulatory change and where we also see some change coming globally is when you'd have a boom, say, for example, like we've had in Brazil over the last several years, raw material prices did very well. You had a lot of foreign direct investment into mining activities, extracting those commodities from a country like Brazil. Also, with those relative value of their raw materials like iron ore or oil going up, the value of their exports increase. So all of a sudden their export profile looks better, their foreign direct investment looks better, and their currency goes through the roof. And so the interaction between relative prices and the global economy has a big impact on amplitude and the amplitude of their currency. Now, as the water is starting to go back, and I use the phrase liquidity implosion, what that means, everybody's just trying to pay back their debt. It's not just the U.S. homeowner, it's corporations, it's hedge funds, everybody's deleveraging, and that money is going back to the source or origin of that money. And so you've seen a rally in the U.S. dollar in the last several months as we were one of the originators of credit for the globe. Also the Japanese yen, that explains a lot of the movement in the yen over the last few months. What my worry is specifically going forward too is as we move through this debt crisis, we're starting to get a handle on that. But as we're starting to see now direct investment be curtailed to areas like Brazil or China, as we're starting to see terms of trade move against those with the commodity prices we've seen, we haven't seen the impact on the currency side. And that, I think, is kind of the end of the whip, so to speak, the little crack around the globe. That would be one of the keys where I would then start to look on the long side. As you said, the major question I think every investment shop around the globe is looking at is at what point do you buy in? We follow earnings expectations, and then also we would wait for that to play out across, really, I think, on currency markets before we would look for the stability we'd want to move in on the long side.
I want to sort of pick up on this point about when the market will turn. But first I want to go back to, I guess, a preliminary question, and that is it possible that it will be a long time before you have a turnaround in the market?
Yes. I mean, it's, my first example, really there's only two examples of this liquidity crisis. I think you can look at the U.S. 1930s and Japan 1990. And, let's face it, Japan is still dealing with relatively low velocity in their income, low velocity in their economy, low velocity of money. And when I see us going through the same steps as what went through in Japan, it's kind of like deja vu all over again, to use that phrase. In that, the Bank of Japan inflated its balance sheet to be about 30% of GDP. We still have not done yet. So we still have a lot that the Fed will do in quantitative easing in comparison to what the Bank of Japan did, and yet still had no response. As an active market participant in Japan in the 1990s too, part of the problem with very large stimulus plans is every business decider, as well as us, we sat on the sidelines until we waited to see if the economy had lift after the stimulus plan tapered off. And so just the existence of government and the stimulus plan, unfortunately, can curtail then private investment coming in. It doesn't act so much as a pump primer then as it takes that space.
No, but Jim, you were talking about so far at least with Great Hill Partners in terms of trying to raise money to make these investments. Mm-hmm. Things are still going reasonably well.
Yeah, we got our commitments in June, mm-hmm. and so that was well before things got very bad. But we've had one capital call since things got bad, and everybody punched in what they were supposed to punch in. So at least with our group of investors, our largest investor, which is public information, is Yale University, which even though they've lost 25% of their endowment based on their public announcements, they're still able to fulfill their commitments.
Are we seeing, what does it look like in the hedge fund world in terms of people buying in?
An investment in a hedge fund doesn't mean necessarily buying on the long side.
Okay.
You can buy, essentially sell on the short side as well. But as far as industry assets go, some of the regulatory failings really have hurt my industry. Hedge fund assets have fallen dramatically and probably will fall by half again this year. And that's, I think, a direct response to, number one, hedge funds overpromise and lack of volatility of returns. They got almost more volatile in some cases than the overall market. But then, and second, you have public trust issues post-Madoff. There really hasn't been a redemption cycle. Now, when I use the term redemption cycle, most hedge funds like myself are open for redemptions 4 times a year, quarterly. The Madoff scandal hit right at the end of December, so it's too late for fourth quarter redemptions. That means that the redemption cycle for the Madoff people responding to that issue is really happening this quarter. Now, on top of that, you have another scandal like the Stanford Financial Group on top of that, and I think we'll probably see substantial withdrawals from the hedge fund industry this quarter and next quarter as well.
So to some level, it's a confidence question.
Confidence in the industry and confidence in the economy as well.
So how do you keep up confidence? I mean, when I pick up the Wall Street Journal, it seems day after day, whether it's Madoff or Stanford or GM saying we're holding on by our fingernails. What is your assessment of confidence going forward? How do you restore it?
That's a broad question. Well, as we go around the country and we talk to local businesses and our competitors, as Paul said, I mean, there's just everybody's on the sidelines, and including us. We haven't made a new investment since last fall. Not to say that we wouldn't, but for the issue I raised earlier, we're not, and that Paul also mentioned, we're not quite sure if we buy something and it proceeds to lose value another 40%, and then for the likelihood of us get back up to the 40 just to break even, and then triple again, which is what we need to make money, you look for that when that trough to that peak that's a big bet. And we don't like making bets that big. Okay. The private equity, we thrive on having private information, right? You have public information. 85% of our investments are from companies that we've known for 3 years or longer, and we have information about them that nobody does, and about their markets, which is why we're able to do a relatively good job of investing in them. Not having that public information or not having that private information is scary to us, and we prefer not to make a risky decision. We're not particularly risk takers, right? I think the pithiest description of what we do is we like to roll out instead of find out. And that's what we like to do. So, but to your broader question, as we run around, I was in Tennessee last week alone. I was in Ohio, Texas, Tennessee, Philadelphia, New York City, and one other place I can't remember. And then the word is the same everywhere, which is confident. Everybody's on the sidelines. Really, most people are clueless as to what's going to happen next. Right. And because of that, we're drawing participation, and which of course just further exacerbates the problem. Whether the stimulus plan and some combination of other things will cause people to start to slowly move back into the markets, it's totally unprecedented.
Well, you make me nervous, because if everyone's sort of sitting on the sidelines waiting for somebody else to make a move,
right,
you may end up having a lot of people on the sidelines. I mean, we had a lot of talk, a lot of excitement, at least in the White House a little over a week ago with the passage of the stimulus plan, which was designed, at least in part, to avoid a repetition of what happened in Japan, sort of lost in the 1990s, as economists like to say. Did you look at that stimulus plan, Paul, and say, yep, we're turning the corner, or were you less charitable toward it?
Well, I want to avoid an opinion or a political opinion in this, but in looking at and trying to evaluate what the stimulus plan, speaking at least my perception of the market's opinion of this, it was not as long a term infrastructure as what we would have liked to see as far as spending. Frankly, though, we still haven't really seen that much from it, specifics from it. So stimulus plan aside, the numbers, though, when you start to work through, earlier I mentioned the debt to GDP ratios. If we're at 350% of GDP, you can kind of pencil out you might need to reduce that level by about 100% of GDP in the U.S. to really get lift to the economy, to bring it back to the same level it was in 2000. Now, to use that multiplier I also brought up of $1 creation leading to 20 cents of GDP, what we're talking about then is removing 100% of GDP, or roughly 13 trillion, and that's a $2.5 trillion headwind that the economy will face then in the deleveraging of 100% of GDP. That's a fairly large output gap we're going to be facing in the U.S. On top of then what, on a historic basis, let's face it, I said 250% of GDP in debt is still a historically very high level. So there is no guarantees that that could get you to that. So we start to gauge what type of money needs to be moved from the private sector onto public books. And in order to get there, you can pencil out, say, $6 or $7 trillion. It would be about the right...
Trillion with a T.
With a T. It would be about the right gauge to have to move on the public books. So if you approach it from those types of numbers...
Translate, what does it mean to move it onto the public books?
That means that if government could step up and supply some type of a national mortgage system, or take on that debt either on the Federal Reserve balance sheet or through removing that debt from the private sector and somehow placing it onto the public books, thereby hopefully freeing up the private sector to start lending again. That's an enormous amount of money, of which the stimulus plan and any banking reform or anything that's been mentioned is not nearly big enough to deal with the problem. Attacking it from the Japanese perspective again, then in the 1990s, I mentioned they had to inflate their Federal Reserve, their Bank of Japan, balance sheet to roughly 30% of GDP. That would be having to bring the Fed's balance sheet up to 4 or 5 trillion, which is currently at 2 trillion. So we still have not, it needs to be a magnitude much more than what people are really discussing, in my opinion.
Your sense of the stimulus plan?
Too small, and not, I agree. Too small and not infrastructure enough focused. I think, though I'm again not making a political statement. I understand the difficulties of all this money has to be paid back at some point, presumably, and trying to strike a balance between enough to make a difference, but not so much that it becomes a self-fulfilling prophecy. But overall, I thought that the amount allocated towards infrastructure improvements, which I think were clearly investments in the future growth, were far too small.
When you say infrastructure, what do you have in mind? A lot of people, they think infrastructure, they're thinking building new roads or highways.
Yes.
But there's a lot of talk now about rebuilding or building our high-tech infrastructure.
Both.
Broadband. So on the broadband side, what would be, or on the high-tech side, what is it that you think is worth doing?
I think more money for the healthcare IT, which I think is a huge thing. I think a government can, if you look at the success of the internet driven out of DARPA, more money into R&D to experiment on technologies. I think the healthcare IT is huge. Is a huge thing.
Can you explain that? Because I don't think a lot of people really understand that there's a very large number, billions of dollars attached to doing something about medical records.
Yeah, electronic health records. I think it's 20 billion.
Yeah.
Something like that. Someone read the
It's
newspaper.
20 million.
Yeah. Basically, it's to try to aid, to create standards around collecting people's medical records and then being able to have control over them and to be able to use them in a more efficient way. I mean, it's right now everybody's, doctor's offices, everything's a million pieces of paper. It's very, something like 22 or 23% of all of the money spent in healthcare is just administration. And it's trying to eliminate that piece of it, make it much more efficient, and make it more secure than it is right now.
Okay, so the idea is you could eventually lower our healthcare costs, which are a large and rapidly growing part of...
And hopefully provide better care by having more current information on patients and sharing it more, appropriately with different, doctors and across institutions and things like that.
And Paul, when you talk about infrastructure, is it the same set of things or other things you would highlight?
Yeah, and frankly, energy is where we think more in terms of, because I don't know if you've seen the headlines, the Chinese government moving in now and buying a stake in Rio Tinto,
which is
a large mining interest globally. Frankly, China is using this in extremely to get down to foreign policy and strategic advantage. They are using this downturn to build strategic advantage in acquiring commodities globally. I have a friend who attended the University of Texas Law School, actually, and his sister is a Nigerian official, and he said the wonderful thing about working with the Chinese is they come in and they will, if you give them a concession for mining, they will provide you with their own security force. They'll build the roads to the mine, and even if you're super nice, you'll get a free soccer stadium from them. An American shows up with a mining concession, and they expect Nigeria to do all of that, and that's not in the realm. So if you look across Africa, there is very long-term contracts being signed now to secure the thing that China really needs to grow. Looking on the other side of this, wherever this happens, I spoke, the demand for commodities as they expand their economy will be enormous. And I really think as far as our own commodity and energy infrastructure, that needs to be put foremost as far as having what I term spreading effects in the economy. By spreading effects, I mean things like if you look at industries like the automotive industry and the formation of the automotive industry, as you had the demand for autos to go up, you had demands for strip steel to go up, as well as you had labor wages that spun off. And eventually, the auto worker could buy his own car and cause demands for other industries to grow, that kind of virtuous circle of growth. That will be the biggest impediment, I think, to our virtuous circle of growth on the other side of this will be energy in the U.S.
Okay, I want to get to the foreign policy consequences in a second. But first, I sort of want you to sort of walk me through how in the world we jumpstart the economy, given something that Jim had said, which is eventually, I mean, I guess you have spending that you consider to be consumption, then you have spending you would consider to be investment, the difference being that spending on investment, you're hoping at some point will allow you to produce more down the road. But obviously, It's no great secret that the baby boomer generation is about to retire. We were running very large deficits before sort of the bottom fell out of the economy sometime last year. With the stimulus bill, we're going to be adding a lot more to our deficit, and maybe have sort of puritanical, born of Scottish Presbyterians view of the world, but debt seems to be a bad thing. And so I'm left wondering if we're sort of borrowing more and more so we can fund the stimulus. How do we get to the point where we can sort of pay this back, or can you just continue to run up the credit card?
Well, the oddity is, and I don't suggest this as a solution, but the oddity is that America's been able to buy this much, or borrow this much money, and we have the printing presses. I can only think of a few times in history another country has been allowed to borrow that much or run up that much in debt in their own currency. Because usually the path is when a country borrows too much, they have to eventually, because the market demands high enough interest rates, say Italy throughout the 60s and 70s, and they had to borrow money in non-lira bonds. And then if they devalued the lira, all of a sudden the debt side of their balance sheet would balloon, and so there's a quite strong punishment for devaluation. The U.S. doesn't have that kind of discipline. We've been able to borrow in our own currency. And so when you get to the question of how do you get out of this situation, that's a real problem, because, like I said, we have two examples. We have the Depression and we have Japan. And we also have what are strengths, if you kind of take a ledger of strengths and weaknesses of the U.S. We've already moved that monetary lever, so that really isn't much of a movement left to go other than quantitative easing. And so I think fiscal stimulus is the only way we can do it. It needs to be just in much larger amounts. And as far as the question is how do we pay it back, therefore the only way we pay it back is, I think, over inflation.
Which presumably isn't good, at least from my economics 101 and
inflation. But it's better than deflation.
Okay, so it's a question of picking your poison.
Pick your poison.
Okay. But I guess here's what I'd like you to explain to me, which is, as in Europe last spring, and the dollar essentially wasn't worth as much as my memory had been the last time I had gone, and the dollar was falling apart. And then suddenly we had this sort of implosion financially, and one of the consequences of it is the dollar actually strengthens, which to many people was sort of awe that you would have the country that sort of mismanaged its accounts has a currency that is appreciating, strengthening. So A, why does that happen? I guess my question B is, how long can it last before smart people like yourself, who are in this business, start to make bets against the U.S. currency?
And first off, how that's happening in the dollar, I think is sort of the repayment cycle we briefly talked about. But let's face it, we had a great strategic industry, and that was Merrill Lynch and Goldman Sachs, and every investment bank that in the U.S. went and bought some of the best houses in London, and all of a sudden we were the real home of global investment banking, which then allowed a lot of foreign companies and hedge funds alike also to borrow money. The place of origin really was U.S. dollars. And so if people are deleveraging, I'm trying to pay back their loans, as you're paying back your bankers, you have to buy the dollars to pay them back. So it causes a little bit of a bump. The second thing is that I think we kind of beat ourselves up a little bit too much in the U.S. though too. We talk about our debt problem. Look at the euro. Look at both UK and Australia have a much higher percent, I think, percent of debt as a percent of global disposable income than what the U.S. has. And so the thought process, although we first coined the term subprime where this started, is really a global phenomenon. It's not a U.S. phenomenon. And I think there's a tendency of governments wanting to kind of point their finger at the U.S. and say, it's you who got us into this. But it's a global issue.
I'm curious, Jim, in sort of the space that you occupy looking for companies, are you at all worried about currency fluctuations, or is that just sort of 18th or 19th in the list of things to worry about?
We only invest in American companies, and for the most part, they're too small to have international operations. And the reason we only invest in American companies is very simple: is there are so many to invest in that part of it's lazy. And if you can get to Providence or Buffalo or Chicago, vacation in Paris. There's just so many companies in the United States to invest in, and we don't have any. I mean, I have some, but as a firm, we don't have any particular expertise in giving value to a company run in Europe. Right. So that the currency doesn't cost us at all.
Okay. As we're going forward, obviously there's a lot of unhappiness on Capitol Hill over the fact that we proceeded with what looks to be, in retrospect, not enough regulation of the financial markets. And I think it's reasonably likely that in the next 12 months we're going to see efforts to create more regulation. Do we need more regulation? Is it the case that now that everybody's sort of burned their fingers, we're going to stay away from collateralized debt obligations and all whatever the funny things are that all these financial geniuses whipped up? Or is there a real need for regulation? And are there bad regulations, good regulations? How do you make sense of?
Well, and you run across a group that really points out that regulations were on the books, but they were just not enforced. But I think you have to look then beyond, well, why weren't they enforced? There's been a certain regulatory arbitrage that's gone on globally, where, say, for example, you take the Stanford Financial Group again, the one that's in the paper more recently. You have a bank in Antigua that is selling product globally for certificates of deposit. So regulators are not able to actually get at the guts to see how the investment vehicle is run, yet they are sold in other markets. And so by having that cross-border capital flow, you need to have a regulatory structure that matches that. Another case in point in the hedge fund industry, if you run an offshore fund, a lot of Reg T and Reg T is a regulation that requires that you have at least 50% of your investment in equity, i.e. it only lets you borrow up to 50% to buy public stock. So if I'm buying shares of Daimler in Germany, under U.S. law, I could only put up $50 of that, and I could only borrow $50, and that would be the maximum amount of leverage. But let's face it now, in international markets, by having offshore funds, it was fairly normal to have 10-to-1 leverage. If your stock was liquid, an investment bank would loan you $10 for every $1 you put up. And so regulations were not matching. So hedge funds sold in the U.S. to institutions that were actually registered offshore could borrow and circumvent a lot of U.S. regulations. And really, as we were talking about earlier, financial accounting regulations and the need for agreement, between countries with that. The SEC, bank regulators, things like that really have to come together and work internationally. Now, so far we've dealt with a lot of the bank insolvency here in the U.S. A real problem exists in some jurisdictions that don't have the money to save those banks. For example, UBS and Credit Suisse, the Swiss regulator is sized much smaller than those global institutions are.
Can I answer that?
Yeah.
I think our perspective is there's three things, at least in the United States, that we think are going to happen. One is eliminating some of the inherent conflicts between the rating agencies and the people that they rate. That just seems like an obvious thing. That it was
Explain what the conflict is.
That the issuers of the bonds and the other financial instruments go to the rating agencies like Moody's, and they then rate the quality of those instruments, and they get paid by the people who they're being hired by the people who are issuing them. So the incentives were for them to.
So I pay you to write a review of me.
Yes.
Okay.
And if you pay me some more, I'll write another review of you. And we can work this out for a
we'll
long time.
Talk about it afterwards. Okay. I like this.
And yes, so did everybody else. And it's just an inherent and obvious conflict that people knew about, but didn't. In a growing market, nobody really figured that there was anything needed to be done. That was thing one. Thing two is just the rationalizing of the American regulatory system. There's just you have commodity futures are regulated by one group, and you have banks regulated by another group, and you have public companies regulated by the SEC, and even just with the United States, you have just this smorgasbord of regulators, and there has to be some simplification and rationalization around that for sure. And then lastly is we think transparency around these instruments, having many more of them on exchanges where you can just see what's happening. So
what do you mean by instruments?
CDOs, the collateralized debt obligations you're talking about. Putting them on an exchange where people can buy and sell them, and there's a market to be made, and there are counterparties, and so it isn't these dark pools of money that is, where it's happening and nobody knows really what's going on and how it's. Those are the three things we think are almost certainly going to happen in some fashion.
So you think this is going to happen?
We think
Not
that.
you're hoping it's going to happen.
Well, we both.
Okay.
We think that's where the trends are going, and we think in the discussions we have with the people we know, whatever that means.
Okay.
Yes.
But I'm impressed.
I know,
Really impressed.
I know more people after January 20th than I knew before.
Okay.
I'll leave it at that. So that's what we think and hope will happen. It might take 2 years or 3 years, but that's what we think will happen. In terms of international, still too early to tell.
Now, these regulations would be good. You think that there'd be a net
Yes.
positive on the end?
Because it would restore confidence. So when you have, there have to be independent raters of these instruments, or then you have true confidence that in fact what you're buying is what you think you're buying, and having one person or one group of people look across all instruments simultaneously and look at the versus the arbitrage that Paul was talking about before, and also transparency. I think almost always has to be good, right?
But then explain something to me, because at least one vision of the way markets should work would be, even if there were conflict of interest between companies and the rating agencies, investors would understand this. It would factor into their decision making, and since they don't want to lose money, presumably they have some incentive to evaluate what's going on. But apparently, as best I can tell,
No, they passed them on to other people who didn't know. I mean, that really what happened, right?
So explain to me how it was, it's sort of at least the simple vision of how the market works, which is people don't want to lose money, so they apply due diligence, didn't hold up.
Well, the thought was that they would just keep passing the risk on to other people who knew less, right? So it's no longer in my books.
I would get in the end.
You'd market these to consumers and to less sophisticated investors who saw the rating, AAA rating,
Right.
and they said this has got to be good. It came from Lehman Brothers, it came from Bear Stearns. It's got to be good, and Bear Stearns thinks now that it's now off its book, so we can move into, we can now fill the pipeline and just keep moving it out. No one ever saw that eventually the end would stop and then it would all roll backwards, which is exactly what happened. So you get, when you, the whole thing has been talked about so much, which is separating the person who actually makes the original investment and absorbed the risk originally, and they pass that risk on, created that disconnection between the real risk and who owned that risk.
And also risk became incented. For example, when you consider Goldman Sachs would lever their balance sheet 40-1, and then they turn around and lever a hedge fund 10-1.
Mm-hmm.
The magnified or see-through leverage became enormous. Now, as long as markets were efficient, and this really was, I think, almost an academic failure in how this was set up. We had this idea of market efficiency and how the invisible hand could work in markets. But very small changes then could cause very large effects later on in the economy. And so that's, I think, in essence, the issue was not an idea of regulation, new regulations that need to be used. It's a way how I think the economy and how the markets circumvented existing regulations to get after far more leverage than what was ever used before, to be able to pass things over to offshore funds, and to also get around the 40 Act and sell to sophisticated investors in the U.S. in ways that were never thought of when the 40 Act was first put in place.
Okay, so this gets back to a point we made in one of our earlier panels talking about it's one thing to have accounting standards, but accounting standards aren't going to work if you don't have some efficient auditing practice and enforcement to make sure people are abiding by the rules.
Right, and to use a directly comparable analogy then to the earlier panel, it used to be in the past that each country could write its own accounting standards because the presence of global large companies was not nearly as large as what it is now. Now with the advent of those supranational organizations, you need a regulatory framework that matches that. It would be equivalent to only having state bank regulators for the U.S. banking system when we became a nation of those states.
But trying to find ways to mesh those different regulatory practices is going to be extraordinarily difficult, particularly when each country feels very strongly that its way is the proper way to do it, and the way they do it is
What gives them a
Heretical.
competitive advantage.
Yes, they're stealing jobs from our workers.
Right.
And I would add, even on your point, it adds a competitive advantage. All of a sudden now, the financial hub like the Caymans or something is offshore that's benefited from that is actually incented more to not be included in that regulatory framework. Because if they can write the regulations over there, and then if that provides them a competitive advantage, the whole thing is incented to fall apart.
So that they can exploit
Yeah.
by being sort of outside the
Yeah.
system.
Case in point, at least in my world, would be in Singapore. Singapore fast establishing itself as the new Switzerland. You saw today UBS admitted to paying a 780 million or billion? No, it must be million. $1 million fine.
Yeah. It was
for doing things they shouldn't have done. At that same rate that UBS and Credit Suisse now are trying to become global banks, Development Bank of Singapore, UOB, are becoming and picking up the baton where Switzerland's leaving them off. And so that is an area that could become very dark for U.S. regulators if they weren't brought into this discussion.
Okay, I actually want to switch gears now because earlier on we were, in actually much of the discussion, we've been sort of talking about, I guess, the business cycle and sort of figuring out when it's going to bottom out, confidence is restored, we're going to rush back into the market will resume and what have you, and it may be 6 months from now, maybe 3 years from now, what have you. But there's some sense that eventually business cycles go from their downward trajectory and begin going back up. But I want to take a sort of broader macro perspective, which is one of the things that's been triggered by the recent downturn in financial crisis is really talk about the long-term decline of the United States. In essence, we're not looking at a short-term business cycle going up here, but rather somehow in some sort of macro sense, the American influence and economic power in the world has sort of reached its peak and is now falling down. My friends would say, well, wait a second, we heard this song and dance about the American decline after Sputnik, and I remember there was some guy named Khrushchev who was going to bury us, and I remember when I was undergraduate looking at data that predicted that the Soviet Union was going to pass the United States by 2001, and unfortunately it went out of business before it could pass us. And of course, for those of us who are old enough, went through the 70s with the oil embargo. And
disco was going to ruin us.
Well, disco did ruin us. God, thank God I burned all those photos in those leisure suits. But then again, you know, at the end of the 80s, there was a lot of talk that the Cold War was over, and Germany and Japan had won. So how do I make sense of this? Is it a case that, in some sense, there is something significant happening right now, and the fact that, it's a lot of people on Wall Street talked about American investment banking houses have basically been toppled, and they're going to be surpassed by financial centers elsewhere. This means a long-term decline in the United States. Or is this just another in a periodic outburst of Americans panicking that they're no longer as good as they once were?
I would rephrase a little bit of, rather than the U.S. declining, it's the ascendancy of other nations. That sounds a lot better.
but the net outcome may be the same, or is it?
Yeah.
You know, and already you're seeing that. What is it? I believe 5 of the 10 largest banks now, 5 of the 10 largest capitalized by market capitalization banks are Chinese. That's a huge earthquake that just happened in the past year. Frankly, I think that that's one of our best hopes, is to develop strong trading partners to grow the global economic function at a higher rate than what we could do alone. And so, you know, there's a great book, Why the Poor Get Rich and the Rich Slow Down, by Dr. Rostand, Walt Rostand, where he deals with this idea of new sectors coming up, driving economies with spreading effects, kind of causing this bubbling going forward. And I think yes, it is inevitable. I think that's what we want. You know, with all this doom and gloom, I think the best bright spot on the globe is 3 billion people are going through industrialization right now. That didn't happen in the 30s or during the 1990s either. And if we can find a way to harness that growth and be part of that, that's very important. Number 2, we have a large amount of savings as a country. Our wealth, you know, when you talk about farmland or houses, I think is radically undercounted. And our savings rate, when you think about home ownership, my parents still have their same home they bought in 1962. It's carried on national accounts at $14,000, which is what they paid for it at that time. So there is a great wealth here in this country that if we can adapt that, if we can help supply that money to then let those 3 billion people grow as quickly and as efficiently as possible, that will lift the global economy with aggregate demand then coming forward, and we'd avoid a lot of the things, frankly, that we talked about, what we fear.
Yeah, I don't think it's that dramatic. I think the next 2 or 3 presidents are going to be explaining to the American people why we don't have the same range of motion that we used to have, and we don't have the same level of power, that unilateral control, because we're actually achieving success in what we're trying to do, which is spreading wealth around the globe, and that through our technologies and that people adopting capitalism and democracy, that you would expect that. This has been going on since World War II. At the end of World War II, when the nations in Europe sort of bottomed out, it's been a pretty steady climb ever since, and it has been great for us. It hasn't been terrible for us. So I think, but when you have Asia with China with $2 trillion worth of currency reserves. I mean, they have some say now in our economy. They didn't have, 10 years ago, they had no say in our economy. Now we can't survive without them. That's a new reality. It isn't necessarily, a disaster, but it's something we have to, this is a new reality that we need to figure out how to change our policies to take better advantage of that. So, meaning that we shouldn't view, and I like what Secretary of State Clinton, it's funny to say that. I lived in Westchester County, and the Clintons lived less than a mile from my house, so I got to see them at Starbucks every so often. I got to meet the Secretary of State.
Did you get an autograph?
Many.
Oh, very good.
It was sort of humbling to see the president waiting in line to go to the bathroom at a Starbucks, though. And only in America, right? With a former leader, you could tell he had to go to the bathroom. And this woman's in the bathroom, and she's taking like 5 minutes, and he's like knocking on the door. It's just kind of, doesn't happen to kings and queens.
The Strauss Center delivers the best in inside gospel.
And I think that through the success of our ability to disseminate technology and knowledge, but we're going to have different policies where we're going to have to share decision making, right? The group G8 is going to have to become bigger. An International Monetary Fund taking account of the BRIC countries, adding new members to the United Nations Security Council. Those are things that Americans are not used to hearing. We called almost all the shots. We still are the single largest voter, and we're still probably going to have the single most important voice. But it isn't. We can't just unilaterally now make a statement and say everybody else line up behind us and off we go.
But let me push you on that, because
Please.
it seems to me that it is going to be a reasonably tough sell to the American people.
Mm-hmm.
In part because I would say you said we've been doing this since the end of World War II, and we're all better off for it. If I were to go to the suburbs of Detroit and offer that up as a general proposition, I don't think you get a lot of agreement.
Mm-hmm.
Indeed, I mean, if you sort of look, let's go back to the primary campaign, when the Democratic primary reached this state, Texas, and Ohio, it was very interesting that then candidate Barack Obama jumped on a position staked out by then candidate, now Secretary of State Clinton, which was that NAFTA was a really bad idea.
Mm-hmm.
And my impression was, being here in Texas, the reaction was, what exactly is wrong with NAFTA?
Mm-hmm.
And the reaction in Ohio, and I would imagine as well in Michigan, was, darn right, it's a bad idea. It's the reason why things are so bad here. And so at least you're with a political problem, which is, let's stipulate that you're right, that we need to learn to share and play better in the sandbox.
Or do we have a choice?
And bring us, well, we may not have a choice, but that doesn't mean you're going to make the correct choice to get there. Because I would think one great difficulty you would have is a policymaker getting up and saying, we should share, is the other side is going to say, you're not willing to fight for us. So how do you get from where we are to where you want to go to make it politically?
Or not where I want to go, where I think it's destined.
Where you think that sort of the forces of globalization or global development are going to push us?
I think it's going to take an awfully long time, and it's going to take just the reality will have to set in. It's going to have to be seeped out. I think it's going to have to be, organizations like the Foreign Policy Association, which you're familiar with, which educates Americans on the importance of being engaged in the world. It's not going to happen overnight. It's probably going to take 10 or 15 years. But, it's going to be an educational process that was it 40% of all of our T-bonds are now purchased by either the Japanese or the Chinese. I mean, now I understand that if you go to someone in Ohio near Columbus who lost their, I mean, that's not going to be a compelling argument to them, but I do think that the knowledge of this reality is slowly making its way across the country. People aren't happy about it, but I think it's going to take 8 or 10 or 12 years to make it sort of part of the operating framework in people's minds. But it's not. I agree, it's not going to be very easy, and I think it's going to be a good deal part of how we approach the problem. And is our relationship with China become more amicable and less threatening? And how do American citizens perceive that overall relationship? Yeah, I know. It's not a simple answer.
And I always think Europe mirrors that problem too. As the EU was brought together, as we were speaking earlier, at least we do have in the U.S. more mobility. You will have a 30-year-old person go across the country to start up a new house. Unfortunately, the 50-year-old unemployed auto worker probably will not. That, I think, is one of the strengths America has versus in Europe. You don't have the Danish fellow moving to Spain as much. You don't have as much of a cross-border flow of the labor force that you do here. And my first memories of this happening were really, remember the song Allentown by Billy Joel, about the death of the steel mills and the steel industry. I think it's something that just is a time and an adjustment that some people will never be retooled. So younger people will then move. And it takes time.
Right, but politically that can be pretty hard because we all know, if those study political science and voting behavior, the older you are, the more likely you are to vote. And the younger you are, the more likely you are not to vote or actually even be engaged in any sort of civic fashion.
Yeah. And you stack that on top of the multi-trillion-dollar bailout package that we started talking about, on top of a lot of things, there's a huge amount of political territory to be covered in the U.S.
If you remember, one of the things that came out of the council studies were that paying more attention to the effects of the people who have lost their jobs, right, and through trade, and if you provided a better safety net for these people and allowed an easier transition with healthcare transitions, that would mitigate a lot of the. And actually, when you explain to people that jobs are being lost because of foreign trade, right, but you're going to have these benefits, it's viewed much more positively than if you just say we're losing jobs to foreign trade and there are no benefits. So there could be some government policy to sort of bridge the gap, right, to use your.
Very good, thank you.
To bridge the gap between being pissed off about losing my job and and I'm not going to support our efforts to become more globalized, and understanding that if I get some benefits from that, I can also transition to maybe taking advantage of the situation.
Well, but it's interesting to point out, as my economist friends would always say, that if you look at sort of job loss in the American economy, very little of it's due to trade. Right. A lot more of it's due to technology, right, and obviously you have sort of the business cycle, which can determine people being employed or unemployed. But sort of going forward, in that, the fact is the notion that trade is costing job really sticks very strongly in much of the American psychology. And which is why I think the issues you talk about having healthcare portability, sort of trying to get people not to be less fearful of change. But it's clear that again, economists would say that everything about classical economics shows that trade makes countries better off as a whole, mm-hmm, but they admit that doesn't make everybody within the country better off, mm-hmm, on whole, and that some people can actually lose a tremendous amount even if you get trained, because if you are 50 years old and you no longer work in the automobile industry and you've now been retrained and you can be a computer programmer, but in Flint, Michigan there are no demand for computer programmers, particularly 50-year-old computer programmers starting at the beginning, you have a serious problem. Mm-hmm. So I guess part of it is, and there is the positive sense, Paul. You mentioned that you got 3 billion new capitalists coming in, and there's potential for a rising tide to lift all boats. But I guess the question is, and there's another possibility, which is you have sort of new emerging powers that do very well, and this country isn't able to grapple with the challenges it faces. It can't get its fiscal house in order, or doesn't have the right policy to produce people, that too many students end up going to film study rather than becoming engineers, one of the sort of common complaints. So I guess sort of looking forward, in your sense, what does the United States need to do to be competitive?
See, if I can, at the risk of answering with a longer answer, my kind of view, you talked about your portfolio companies that are still executing and the economy is still growing.
Well, they're growing within the economy, yeah. But the economy's not growing.
For us, our kind of growth area that we're still hanging on to is the Chinese consumer. Mm-hmm. And that's one thing that's very different. When I was, first time I went to Shanghai, we had a meeting with the president of the People's Bank of China. And he opened a conference with a phrase that said, essentially, the Americans don't understand, we view it as a national policy threat or security threat to us to be dependent on a U.S. consumer. So we need to figure out a way as Chinese government to increase domestic consumption within China to make the lives of the everyday guy better in China. That sounds like a small statement, but that's actually a huge statement, because what he was really foreshadowing, I think, is a transition of China from an export-oriented country to a domestic demand-driven economy. And that's that virtuous circle, exactly what I was talking about with spreading effects in the automotive industry. If they're able to juice their domestic economy enough through infrastructure and increase domestic spending to start that pump within them, a very interesting thing happens at the Bank of China. And that all of a sudden the weight and the advantages of having a relatively low currency move to the advantages of having a relatively high currency. Put yourself in the feet of a Chinese businessman. If you have a stronger, strengthening currency, all of a sudden that oil you're buying in dollars is cheaper. So the commodity inflation is bled off by having a higher currency rate.
You know, we addressed issues of immigration, intellectual property, outsourcing, domestic engineers in the United States. And I think in the end, the main conclusion that we came to, as we're still coming to, that the most important thing we can do to be competitive is to keep the framework in the United States for businesses to get started, the legal framework. The most important thing is to keep the framework sound. Try to minimize, ridiculous lawsuits, overregulation, access to capital. I mean, it's hard to say how many engineers you need and how many immigrants you need. I mean, clearly you want immigrants to be able to come into the country. Clearly you want people to study engineering. Those are hard things to sort of put on a dial and say what the number should be. But the most important thing we can focus on is making sure the framework is correct, and that we're providing the rule of law, the contracts are still valid, that we eliminate ridiculous lawsuits. That's the main thing. And all the other stuff, if you put those frameworks in place, all the other stuff will sort of rise to the right level. And if it's lucrative for people to become engineers, they will. If it's not, they won't. And without trying to micromanage the process, saying we should have 60,000 highly educated immigrants a year versus 120,000 versus 220,000. Nobody's smart enough to know all that stuff. It's just keep the framework clean and constantly look at where the works are getting gummed up, and try to focus on making it ungummed, and then that's the best thing you can do. We sort of came to that conclusion.
This is the Council on Foreign Relations widely acclaimed project. Now, I'm just curious, two things, Paul, just to go back a second, which is one, in your scenario about the Chinese all of a sudden becoming more of a sort of having domestic demand rather than export-led demand, isn't there a downside in that, at least for the foreseeable future, U.S. policymakers are hoping that the Chinese are going to run big surpluses so they have all those dollars sloshing around, and they'll go and buy U.S. Treasury securities so then we can afford to run our deficit.
When in reality, if you subscribe to that view that they will turn more inward again as the global economy starts to slow down, they'll use those surpluses, that $2.5 trillion stacked up in foreign currency, to go and buy what they need. And they need commodities. They need technology. And so it
but
is.
But if they're not buying Treasury notes, then that means you got to jack up your interest rates to attract capital to run the deficit, right?
Right, but if we have a Federal Reserve that's in quantitative easing mode, they'll just monetize that and buy it. So
just run the printing press.
So oddly enough, I think that is what they're going to do. I think that's what is most logical.
And that leads to inflation.
Down the road.
Which is better than deflation.
Okay, I want to have talking points going. Just quickly, you said you're pessimistic about Europe.
Because I do think it's interesting as you go through the news, we're so wonderful at pointing out every bad thing that the U.S. can do and how we're the origin. But I mean, as far as structural problems and adjustments, Europe faces quite a few of those too. They're relatively new to a debt issue as well. Home ownership rates went through the roof in the UK and across Europe. And that's a new phenomena for them. And this is going to be their first real strong housing, second real strong housing bust to deal with, say, for example, in the UK. So I think prospects for the US, frankly, are much better than prospects for growth coming out of Europe, while they deal with a lot of the same issues we're grappling with. As we pointed out with the accounting standards issue, if the answer is always a two-track system, they're going to have to deal with twice the government amount and spending to deal with the same problem we would.
Fair enough. I guess at this point, I'd like to bring the audience in. If the audience has any questions they want to ask of Jim or Paul.
You're supposed to leave at 6:30, but I'm glad you stayed.
Very interesting discussion. I actually would like any of the, thanks for coming, first of all. I think it's been great. The discussion was great.
He came like 5 miles, I had to go there.
My question is about the future of jobs in the U.S. or future of perhaps manufacturing jobs or other kinds of jobs, service jobs. I mean, what do you see in the next 10, 20, 30 years? What type of jobs would be created in the U.S.? Whether it be primarily manufacturing, whether it be service-oriented, and what type of sectors would be thriving?
Wow. I think there's sort of an inexorable move up the, if you look at I saw an interesting presentation last week in New York City about I want to say knowledge workers, but workers where answering questions and assessing problems becomes a larger, 100 years ago, nobody did that really in our economy. And now it's about 35 or 40% of the workforce has some type of knowledge component to what they do. And I'm not talking about at a Burger King where it's you want 2 pickles or 3. And I'm not being facetious. It's not including that.
Right.
It's a real, whether it's it's a help desk or an executive, and that I don't see any change in that happening. I mean, it's going to top out at some point, but because of the invasion of technology into everything we do, it's requiring people to be able to think more, and it presents the opportunity for information to come to them, which then creates more value. As you aggregate information, that becomes value into itself as you abstract another level above that. So I just think that the knowledge worker is going to continue, but I mean, which sectors of the economy I'm not qualified to. I don't know. Your guess would be as good as mine.
And a lot of people confuse me for a pessimist. I am really an optimistic person. I mean, and especially on a 10-year look. Usually, I mean, it just has to be with
just not now.
With these short-term considerations we're talking about. I mean, longer term, I do think the largest story, ever written really in the global economy, is sitting right in front of us. The development of what's going on in Asia it dwarfs so much that I think that there's a huge. One should be looking forward to the future. But if you're talking specifically in the U.S., we do some things with agriculture. As population growth increases, as global wealth increases, the demand for protein increases. And that's one thing the U.S. does very well. You look at the average size farm in France, I believe, is 40 acres. Here in the U.S., it's now north of 300 acres. And because it's larger farms, we can apply more technology, job opportunities in biotech, what's going now with drought-resistant corn and things that we can get more food value out of the ground is a huge thing that the U.S. has a competitive advantage in, and it's something that definitely the world needs going forward. So that's probably, if you have to pick what is a longer-term sector I'd be interested in, it's food. Second would be energy.
And it's also quite possible we will have job growth in jobs we've never heard of.
Mm-hmm. That's the point.
I was going to say, if you would go back, when I was, God, it is 30
Just
years.
going.
30 years ago, when I was wearing my leisure suits, a lot of the jobs that exist today, no one would have ever heard of. And I was in college at a time where you went to the computer center, you got a deck of cards,
Yeah.
you had to punch them, and God forbid if you tripped.
Missed one.
No, actually, my recollection was 4:30 in the morning. It's the only time you could actually get access. Tripping and dumping 600 cards on the ground.
You did that?
Yeah, I did that. And you had to sit and get them all in the right order, and there was gum on the floor. And next thing, and now I live in a world in which you pull out this little, Dick Tracy-like device anywhere in the globe, and you can see what's happening. So, I think it's hard to imagine what the future is going to be like. I think for the past 30 years, how much change we have witnessed.
Yeah, I spent my whole career in software, and it didn't really exist, at least in the form that. So, if you had said, "What do you want to be when you grow up?" When I was in high school, the word software was not. No one had ever heard that word before. Soft ice cream, but that's okay.
Yes.
Thank you very much. This is a really interesting discussion. I thought you touched on so many different things that a bunch of questions were popping up in my mind. I was hoping to have a chance to ask some questions. One thing that I wanted to talk about, you're seeing Asia as a growth sector, sort of a life preserver almost for the global economy going forward. I heard that Japan actually had a 12% reduction in GDP in the fourth quarter, and which brings their GDP back to the early 90s.
Well, annualized figure, yeah, 12.5%.
So what does that say about Japan's experiment with their stimulus packages?
No, and that's the paradox that I experienced in the 90s, is we'd be sitting there wanting to invest into Japan, because I started my career in 1990 just as the Japanese market peaked out and started to come down. And that's the curious thing about having large stimulus packages passed. It forces private industry learns to sit on their hands until they see if that economy has lift. So, as we were talking about earlier, you were hoping it'd be more infrastructure. To me, infrastructure has a longer tail of effect on the economy than does a stimulus check or a shorter term stimulus is played out there in the economy. Truth is, right now we need short-term stimulus, but then we also need a longer term or longer life activity, I think, in the economy to take a different path than what Japan had.
But here we are 20 years later, and stimulus package after stimulus package after stimulus package after priming the pump in Japan, and they're right back where they started from. So
yeah, and you also have a
uniquely
demographic issue in Japan as well that's working very much against them. And when I say Asia, I really mean Asia non-Japan as well. To me, as well as in my industry, most traders and most desks deal with Asia and Japan as a separate area.
Yeah, I think you should also point out about Japan in the 90s, as I understand it, that its sort of period was a slowdown. It wasn't that it was contracting over the course of the 90s. It grew, but it grew at a much lower rate than it had grown in the 60s, 70s, and 80s. And I think only 2 or 3 years was growth negative.
Yeah, it's kind of hooray we didn't have a depression there. Yeah. The aggregate demand almost, or ultimate demand from the West was able to buoy a country like Japan. To use that analogy to today, I hope that aggregate demand coming out of Asia can help buoy Europe and the U.S.
Yes, Kate.
Just to follow up to Brett's question, I had exactly the same concern. Are we putting our hopes too much on China? Because all the news coming out of China in the last couple of months is actually ever decreased expectations of growth rates and growing concerns about unemployment. So what happens if China doesn't do it for us?
That's a problem.
Plan B.
I think objectively looking at it, where in the world do we have consumers that can increase demand? Where's the end demand pull going to come from? In 1990, as Japan slowed out, the U.S. consumer, remember, came back to the rescue with low rates from the Federal Reserve, caused an increase in demand, and we recovered first, which then pulled the world out. Unfortunately, I think the only place you can really expand domestic consumption is in Asia. We already have a new house, and we have 3 cars, and we have everything we need, and more, with an aging population. And so, to a certain extent, I point to China and point to Asia because they can, number one, and number two, that is about all we got.
To the point I made earlier, I think that our approach to China and our relations to China obviously have a huge amount of impact on what actually happens. I mean, our attitude towards China is going to be hugely important. How mutually beneficial that relationship is, and I think that the way the current administration and the fact that Secretary of State went to China was her first overseas visit.
Right.
And Geithner, notwithstanding his comments on managing the currency, I think overall.
You may want to explain that Tim Geithner during his confirmation hearings made a comment that he thought the Chinese were manipulating their currency,
Right.
which was taken by the Chinese very badly to suggest that we were going to see some democratic-inspired regulation punitive against
Right.
the Chinese.
And the Chinese government was very loud and vociferous about its negative reaction to that comment. So, but be it as may, he doesn't make foreign policy.
Well, the cynic's
right.
interpretation of that is that was a way to just sort of build favor with a wing of the Democratic Party, which has been beating this drum for quite some time,
Mhm.
as opposed to trying to make serious
And it
policy.
was actually in written notes and were never actually delivered to the Congress, right? So, but I think our approach to China is more of a co-opetition and trying to not view them as a threat. I think our attitude will have a huge amount of impact onto whether they do it for us.
Well, I think one of the interesting questions going forward is if the Chinese economy slows down, China may end up having more social strife. We're already seeing signs of that.
Right.
And the question is, could China potentially find itself falling in a situation where it's in a vicious circle as opposed to a virtuous one?
Yep.
That's going to be one of the very interesting things going forward, which brings us back to the issue that economics is never that far away from politics and vice versa. And I think one of the challenges for an organization like the Strauss Center is trying to understand the interactions between the two. Listen, I want to thank Paul Rogge. I want to thank Jim Doherty for coming here for an excellent set of remarks. I want to thank the audience for coming. But please join me in thanking Jim and Paul.